Bond stocks real estate, the full breakdown. Hey everyone, welcome back. From March 2022 to July 2023, the Federal Reserve raised interest rates 11 consecutive times, from near zero to 5.25 to 5.5%. It was the fastest tightening cycle in 40 years. The Bank of England, the ECB, and central banks across the developed world followed with their own historic rate hike sequences. This wasn't an abstract policy shift. It was a redistributive event, one of the largest transfers of financial fortune in recent memory, playing out quietly across bond portfolios, equity holdings, mortgage statements, and savings accounts. Some people made a great deal of money. Some people lost a great deal of money. Many people did both, depending on which part of their portfolio you're looking at. Today we're going to map the winners and losers of this rate hike cycle systematically, across bonds, equities, and real estate, and draw out the lessons that are most practically useful for understanding how interest rates reshape the financial landscape. Let's get into it. Before we look at winners and losers, we need to be clear on the mechanism. Why do rising interest rates push asset prices down? All financial assets are, at their core, claims on future cash flows. A bond pays you coupons and principal over time. A stock entitles you to a share of future profits or dividends. Real estate generates rental income. The price of any asset is determined by the present value of those future cash flows, and present value is calculated by discounting future cash flows at an interest rate. When interest rates rise, the discount rate rises. $1 of cash flow expected 10 years from now is worth less in present value terms when rates are 5% than when rates are 1%. Therefore, all else equal, when rates rise, asset prices fall. This is not a matter of opinion or market sentiment. It is arithmetic. The sensitivity of an asset's price to rate changes depends on the duration of its cash flows, how far into the future they extend. Long-term bonds, whose cash flows stretch decades into the future, are exquisitely sensitive to rate changes. A 30-year Treasury bond can fall 20 or 30% in price when rates rise by a few percentage points. Short-term bonds barely move. Growth stocks, companies whose profits are projected to arrive far in the future, behave similarly to long-duration bonds. A company priced at 100 times earnings, justified by explosive growth projected for a decade hence, sees its valuation framework collapse when rates rise. Value stocks, companies generating substantial current earnings, are less affected because more of their cash flow arrives in the near term. Cash and short-term deposits, conversely, benefit directly from rate increases. They generate the rate. Everything else adjusts around them. Keep this framework in mind as we go through the specific asset classes. 2022 was the worst year for bonds in modern financial history. The Bloomberg U.S. Aggregate Bond Index, a benchmark that includes treasuries, corporate bonds, and mortgage-backed securities, fell approximately 13%. Long-duration government bonds fell far more. The iShares 20-plus-year Treasury bond ETF lost roughly 31% in a single calendar year. To put that in perspective, bonds are supposed to be the safe part of a portfolio. The conventional 60-40 portfolio, 60% equities, 40% bonds, exists because bonds are expected to rise when stocks fall, providing a cushion. In 2022, both fell simultaneously. The diversification benefit that bond holders had relied on for decades evaporated. The most dramatic institutional casualty of this dynamic was Silicon Valley Bank, which collapsed in March 2023. SVB had accumulated a massive portfolio of long-duration mortgage-backed securities during the low-rate COVID years, reaching for yield in an environment where short-term rates offered nothing. When rates rose, those securities lost substantial value, unrealized losses that the bank was not required to disclose on a mark-to-market basis under its accounting treatment. When depositors became aware of the scale of losses and began withdrawing funds, SVB was forced to sell bonds at a loss to meet redemptions. The disclosure of those losses triggered a classic bank run, accelerated to an unprecedented pace by social media and digital banking. SVB went from functional to failed in 48 hours. Signature Bank followed days later. Credit Suisse, already weakened, required an emergency rescue by UBS arranged by Swiss regulators. But the bond story has two chapters. The first is loss for existing holders. The second, for those who bought bonds during or after the rate hiking cycle, is opportunity. A 10-year U.S. Treasury offering a 5% yield in 2023 was genuinely attractive for the first time in 15 years. European government bonds, which had traded at negative yields as recently as 2021, offered positive real returns for the first time in years. Money market funds in the U.S., paying 5% on short-term paper, attracted over $6 trillion in assets, a record inflow driven by investors rediscovering the appeal of safe, high-yielding cash equivalents. The lesson: your outcome in the bond market during this cycle depended entirely on when you bought and what duration you held. Those who bought long-duration bonds before rates rose lost significantly. Those who shifted to short-duration or money markets as rates rose, captured attractive yields for the first time in a generation. The equity market during the rate hike cycle was not one story, it was several competing stories playing out simultaneously, with dramatically different outcomes depending on which segments you owned. The S&P 500 fell approximately 19% in 2022, a significant bear market but not a collapse. The Nasdaq fell around 33%. But within those averages, the dispersion was extraordinary. High-valuation growth stocks were the clear losers in 2022. The mechanism is the one we established. When rates rise, the present value of distant future earnings falls. Companies trading at price-to-earnings ratios of 50, 100, or 200 times, justified by projections of explosive future growth, saw their valuation frameworks destroyed. Netflix fell roughly 51%. Meta fell approximately 64%. PayPal lost over 60%. Peloton, Zoom, Shopify, the COVID darlings that had reached absurd valuations in the zero-rate era, fell 70 to 90% or more from their peaks. Unprofitable growth companies, venture-backed startups that had gone public on the promise of future earnings, fell even further, with many down 90% or more. Value stocks and high dividend payers were the relative winners. Energy companies, Exxon, Chevron, Shell, generated extraordinary profits as energy prices surged and their cash flows, anchored in the present, were barely touched by the rate discount dynamic. Financial stocks broadly benefited from net interest margin expansion. Banks earn more when they can lend at high rates while deposit costs lag. J.P. Morgan Chase posted record profits in 2023. Defense stocks performed well as geopolitical tensions elevated spending commitments. Then came the exception that overwhelmed everything else: artificial intelligence. Nvidia's stock rose approximately 239% in 2023 alone, driven by insatiable demand for its AI training chips. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, collectively drove the majority of the S&P 500's returns in 2023 and 2024. An investor in an equal-weighted index of the S&P 500 had a very different, and much less impressive, experience than one in the market cap-weighted benchmark. The AI trade created a curious exception to the rate sensitivity rule. These were, by historical standards, high-valuation companies. Their profits extended far into the future. Under normal conditions, rising rates should have compressed their multiples. Instead, the perceived magnitude of the AI opportunity, the possibility of transformative productivity gains across the entire economy, was large enough to overwhelm the discount rate effect. Investors were willing to pay for optionality on a technology they believed could be worth trillions. Whether that belief was correct remains to be seen. The housing market confounded predictions. Most analysts in 2022 expected that a doubling of mortgage rates, from roughly 3% to over 7%, would trigger a significant decline in home prices. It largely did not. The explanation is the lock-in effect, one of the more counterintuitive phenomena in recent economic history. During 2020 and 2021, tens of millions of American homeowners refinanced their mortgages at historic lows. Many locked in 30-year fixed rates at 2.5 or 3%. When rates rose to 7%, these homeowners faced a stark choice: sell their home and take on a new mortgage at more than double their existing rate, or stay put. The overwhelming majority chose to stay put. The result was a historic collapse in housing supply. Existing home sales fell to multi-decade lows. Inventory, the number of homes available for sale, plummeted. And when supply collapses, prices don't fall even when demand weakens. U.S. national home prices, which many expected to fall 10 to 20%, instead declined only slightly in some markets and continued rising in others. By 2024, prices in many markets had returned to or exceeded their 2022 peaks. This created a paradoxical housing market. Extremely expensive by historical standards, in terms of both price and the monthly payment required to buy, yet with prices that showed little sign of the correction that affordability fundamentals seemed to demand. First-time buyers were effectively frozen out of the market, priced out by both the purchase price and the cost of financing. Commercial real estate told a different story. Office properties in major U.S. cities faced a structural demand shock from the permanent adoption of hybrid and remote work. Vacancy rates in cities like San Francisco reached 30% or higher. Buildings that had been worth hundreds of millions of dollars a decade ago were transacting at fractions of those values, or not transacting at all. The regional banking system, which had significant exposure to commercial real estate loans, came under stress, a concern that remains active heading into 2025. In Japan, the story diverged from the global pattern. The Bank of Japan's ultra-low rate policy, maintained through most of this period, kept domestic mortgage rates near historic lows. Combined with the depreciation of the yen, which made Japanese assets dramatically cheaper for foreign buyers in dollar or euro terms, prime urban real estate in Tokyo and Osaka continued to rise through 2023 and 2024, making Japan one of the few real estate markets globally to see sustained appreciation during the rate hiking cycle. Beyond the obvious story of who got hurt, there were genuine beneficiaries of the rate hiking cycle, some expected, some surprising. The most straightforward winner was anyone holding cash or short-duration fixed income. Money market funds paying 5%. 6-month Treasury bills yielding 5.4%. High-yield savings accounts offering 4 or 5% for the first time in 15 years. In an era when cash is trash had become a financial mantra, cash suddenly became competitive. Total assets in U.S. money market funds exceeded $6 trillion by 2024, a record driven by investors who, for the first time in a generation, could earn meaningful risk-free returns simply by waiting. Retirees and near-retirees, who hold disproportionately large cash and fixed income positions, saw their income streams revive substantially. Banks were large-scale beneficiaries, at least the well-capitalized ones that hadn't overloaded on long-duration assets. Rising rates expanded net interest margins. Banks could reprice loans upward faster than they had to raise deposit rates. J.P. Morgan Chase, Wells Fargo, and Goldman Sachs reported record net interest income. The handful of smaller banks that failed, SVB, Signature, First Republic, were the exception that proved the rule. The banking sector overall benefited from the rate environment. Insurance companies similarly benefited. Insurers take in premiums and invest them to generate returns. For years of near-zero rates, they struggled to earn adequate returns on their fixed income portfolios. Rising rates allowed them to reinvest at dramatically higher yields, improving their financial positions substantially. The carry trade, borrowing in low-rate currencies to invest in high-rate assets, generated large profits for those who implemented it correctly. The Japan carry trade, funded by ultra-low yen borrowing rates and invested in US dollar assets yielding 5% or more, was one of the most profitable macro trades of 2022 and 2023. The risk of this trade became visible in July and August 2024, when the Bank of Japan's signal of rate hikes triggered a rapid unwind of yen carry positions, contributing to a sharp but short-lived global market sell-off. Finally, and most consequentially for individuals, those who owned real assets, carried low fixed-rate debt, and held diversified portfolios navigated the cycle far better than those concentrated in long-duration bonds or speculative growth assets. The lesson isn't about timing the market. It's about not making concentrated bets on any single interest rate outcome remaining in place forever. The 2022 to 2024 rate hike cycle was one of the most comprehensive stress tests of the modern financial system in recent history. It exposed the vulnerabilities of long-duration assets when held by institutions that couldn't absorb mark-to-market losses. It devastated high-valuation equities that had been priced for perfection in a zero-rate world. It froze the housing market in a way that kept prices high while making affordability worse. And it generated substantial, if underreported, benefits for holders of cash, short-duration instruments, and banks. The practical lessons are several. First, interest rate duration is a real risk, and one that many investors had stopped thinking about after 15 years of declining or zero rates. Second, diversification across asset classes and duration is not a guarantee of protection. 2022 proved that, but it remains the most reliable buffer against scenarios you didn't specifically predict. Third, the relationship between the interest rate environment and asset valuation is mechanical, not mysterious. When rates rise, long-duration asset prices fall. When rates fall, they rise. This is not complicated, but it requires active thinking about what kind of environment you're positioned for. And the final observation. The rate hike cycle is now transitioning. The Fed began cutting rates in September 2024. The path of rates from here, back towards some new normal, wherever that lands, will create its own set of winners and losers. Understanding the mechanisms means you'll be better positioned to see that transition coming. Thanks for watching. If this series has been useful to you, a subscribe and like makes a genuine difference. See you next time. Thank you so much for watching until the end. If you have any questions or comments, feel free to leave them below. We're also looking for topics you'd like us to cover next, so let us know. Don't forget to subscribe and hit the like button if you enjoyed this video. Don't miss the next episode. Subscribe to the channel and hit the bell.